Okay, let's unpack this. October 19th, 1987. I mean, just saying the day evokes something, right?
It really does. A day etched in financial history.
Absolutely. Imagine this. You're watching the market and the Dow Jones Industrial Average just nosedives. A staggering 22.7% drop.
In one single day. 508 points, gone. Poof.
The scale of it, points and percentage, is just mind-boggling. It's still the biggest one-day percentage loss ever for the U.S. market.
Yeah. And while people sometimes use Black Monday for other events way back, for modern finance, this is the Black Monday.
Definitely. And for this deep dive, we've got, well, quite a stack of material. Academic papers, Fed accounts, even firsthand recollections from people who lived through it.
Right, some really compelling stuff.
Our mission here is to cut through that complexity, really explore these sources, and get a handle on what happened, what actually went down on Black Monday 87.
We need to look at the lead up, the day itself, obviously, but also the immediate aftermath, the response.
And maybe most importantly, the lessons. What changed because of this? What can we still learn?
Exactly. We'll touch on triggers, the market mechanics of the time, the human side of it, and the safeguards that came later.
So get ready, everyone listening. We're going to get informed, maybe find some surprising facts, and really try to understand this pivotal moment.
Yeah, it's pivotal because it wasn't just, a bad day for stocks. It felt like the whole system was teetering. Global impact, but centered right here in the U.S.
Understanding that chain of events, how things interacted, how people reacted under that pressure, it tells you so much about market.
And about stability. Or the lack thereof sometimes.
Okay, so let's set the scene first. Was the market already tanking before October 19th? What was the mood, say, earlier in 1987?
Well, that's one of the interesting wrinkles here. The sources make it clear the market wasn't in some long, drawn-out decline. Actually, quite the opposite.
Really? So it was doing well?
Yeah, 1987 overall had been a pretty strong year for stocks. Going into October, the market was actually up quite significantly year to date.
Wow, so there was optimism.
Definitely. Some sources even use the word exuberance, which of course made that sudden sharp drop feel even more like a bolt from the blue. More shocking.
So not a slow slide into chaos, but more like falling off a cliff from a high point.
Pretty much. But, and this is important, while Black Monday itself was the main event, the sources are clear it didn't happen in a total vacuum. There were tremors before the earthquake.
Ah, okay. Warning shots, you mean, like in the week just before.
Exactly. The week leading right up to the 19th saw some pretty significant declines that, in hindsight, definitely foreshadowed what was coming.
Which days are we talking about specifically?
The sources really zeroed in on Wednesday, October 14th, and then especially Friday, October 16th. Those were days with substantial drops.
Okay, substantial. How bad are we talking contextually for 1987?
Well, think about this. On Friday the 16th, the Dow dropped 108.35 points. Now, 100 points today with the Dow where it is isn't a huge deal, relatively speaking.
Right, barely registers sometimes.
But back then, that 108-point drop was, at that exact moment, the largest single-day point drop the Dow had ever recorded.
Wow, the biggest point drop ever on Friday.
Followed by the biggest percentage drop ever on Monday. It just shows you the speed, the acceleration, the sell-off in that critical few days.
That really paints a picture of how quickly things unraveled. Okay, so the market's already shaky. Records are breaking on the way down. What specific triggers or factors did the sources point to for why this was happening, leading up to and including the big one?
This is where it gets really interesting and a bit complex. It seems to have been a mix of things, some fundamental economic stuff, some more structural market issues.
Okay.
But one really specific thing the sources identify, especially for those drops on the 14th and 16th before Black Monday, was a piece of proposed legislation.
Legislation, like a new law. What kind?
It was a tax bill being worked on in the House Ways and Means Committee. And the sources built a pretty strong case that this bill, specifically some provisions aimed right at corporate takeovers and restructurings, spooked the market.
Ah, takeovers. The 80s were famous for that, right? Mergers, LBOs, all that activity.
Exactly. It was a huge part of the market dynamic. Lots of value or perceived value being created through these deals. Think, corporate raiders, greed is good, stereotype, all that.
Right. So what did this bill propose to do?
It aimed to put the brakes on that activity. The sources detail specific things, limiting, maybe even prohibiting, the tax deduction for interest paid on debt used to finance takeovers.
Okay, that would make buyouts more expensive.
Definitely.
Yeah.
It also proposed forcing companies to recognize taxable gains immediately if they sold assets after being acquired. And even hitting hostile takeovers treated as asset purchases with immediate taxes, plus a special tax on green mail.
Green mail. That's when a company pays a premium to buy back shares from someone attempting a hostile takeover just to make them go away.
Precisely. So the bill was basically stripping away tax advantages and adding tax disadvantages to M&A deals.
What was the logic behind it? Why did the committee want to clamp down on takeovers?
According to the sources, the committee's stated view was that hostile takeovers were, well, bad, detrimental to the economy, harmful to employees, bad for the communities where these companies operated. They wanted to remove the tax incentives and actively discourage them.
Okay, so they saw M&A as destructive and were using taxes to fight it. How did the market analysts think this would play out more broadly, beyond just the companies doing deals?
The hypothesis was this. Many saw takeovers, even hostile ones, as a way to discipline management, improve efficiency, unlock value for shareholders, basically, reduce what economists call agency costs.
Okay, the costs when managers' interests don't perfectly align with owners?
Right. So if you suddenly make this mechanism much harder or more expensive through taxes, the theory was it would reduce potential shareholder wealth across the market. It would lower the value of all firms, especially those considered potential targets, the in-play companies.
Because a key way to potentially boost their value was being taken off the table.
Exactly. And it could bias investment away from potentially efficient takeovers towards other, maybe less economically useful activities that didn't face these new tax hurdles.
Yeah.
The market, seeing this, would logically have to reprice companies lower.
Makes sense. If a value driver is attacked by policy, investors react. Did the market actually move when news of this bill came out?
The sources track this very closely. The first whiff of these anti-takeover provisions apparently hit the news wires late on Tuesday, October 13th. Then the committee actually approved the bill late on Thursday the 15th.
So the market's first real chance to react to the initial news was Wednesday the 14th.
Correct.
And then to the official approval on Friday the 16th.
Precisely. And the data is pretty stark. On the 14th, the S&P 500 dropped 2.95%.
Okay.
Then on the 16th, it fell a massive 5.16%.
Wow, those are huge single-day drops, even before Black Monday itself.
Absolutely. And the source's statistical analysis flags these as highly significant negative returns, way outside the normal day-to-day fluctuations.
And what about those in-play companies, the takeover targets? Did they react differently?
They did. The researchers created a specific portfolio of stocks widely considered to be potential takeover targets at the time. And that portfolio showed significant negative abnormal returns on both the 14 and 16.
Abnormal returns, meaning they did even worse than the overall market decline would suggest.
Exactly. They were hit harder, which strongly suggests the market saw this bill as directly hurting their potential value. It fits the hypothesis perfectly.
That is compelling. What about the pros who trade these deals for a living? The risk arbitrageurs, what were they doing?
The ARBs. Yeah, their activity is a great indicator of how likely deals are seen to close. They basically bet on the spread between the current stock price and the announced deal price.
So if they're buying, they think the deal will happen. If they're selling,
they're getting nervous. And the sources looked at trading data from major risk ARB desks. Before this news broke, like early October, they were net buyers, positive buy-sell differential, betting on deals. But during October 14th to 16th, that flipped dramatically. They became significant net sellers. For instance, the group tracked sold millions more dollars worth of shares than they bought on both the 14th and 16th. Their buy-sell ratio plummeted.
So their action screamed, these deals look much riskier now.
That's exactly the interpretation.
Yeah.
The tax bill seemed to be directly impacting their assessment of takeover viability and profitability, causing them to bail out.
Did this pattern reverse later? Like, if there was news the tax threat was easing up?
It did. The sources followed the timeline. Later in October, after the crash on the 28th and 29th, the Ways and Means chairman, Rostenkowski, made comments suggesting they might compromise on these provisions. And then much later, in December, the House and Senate negotiators formally agreed to drop most of them.
And the market reaction then?
Positive. Consistent with the idea that the bill was a negative weight. The S&P 500 had positive returns around the news of compromise in late October, and again when the provisions were officially dropped in December.
And the takeover stocks and ARBs, same story. They showed positive abnormal returns doing better than the market, and ARB buying activity picked up again on those dates. It really strengthens the argument that this tax bill was a major negative catalyst right before the crash.
Okay, that's a very specific data-driven case for the tax bill. Was there anything else suggesting a U.S.-specific problem brewing that week?
Yes, another key piece of evidence the sources highlight is comparing the U.S. market's performance to the rest of the world during those crucial days, the 14th and 16th.
How did they stack up?
Dramatically different. On October 14th, when the S&P 500 fell almost 3%, the world market index, excluding the U.S., actually rose slightly.
Wow.
And on the 16th, when the S&P plunged over 5%, the non-U.S. world index declined less than 1%, almost insignificantly. The difference in performance was statistically significant on both days.
So the U.S. market was falling off a cliff while the rest of the world was not. Largely, yes. It strongly suggests that whatever was driving the initial severe declines in the U.S. on the 14th and 16th was primarily a U.S.-specific issue, which fits perfectly with the timing of this U.S. tax bill news.
Okay.
So the conclusion from that line of research is that this proposed bill wasn't just a factor, but a major identifiable economic trigger for the pre-crash sell-off, which then likely set the stage for the panic on the 19th.
Okay, the tax bill is a strong suspect for kicking things off. Were there other pressures mentioned, other economic worries swirling around?
Yes, definitely other contributing factors. Another piece of bad news hit on October 14th, same day the market first dropped hard, which was a higher than expected U.S. trade deficit number.
Ah, the trade deficit. That was a big worry back then too, wasn't it?
Huge. The figure announced was $17.6 billion for the month, when forecasts were closer to $15 million. That miss definitely added to the negative sentiment on the 14th.
What were the specific fears linked to the trade deficit?
The main worry was about the dollar. A big deficit suggested the dollar might need to fall further to make U.S. goods cheaper abroad. And if the dollar's falling, you might need higher interest rates, higher treasury yields to attract the foreign money needed to fund the U.S. government's debt. Plus, underlying fears of protectionism, trade wars, which markets hate.
So, more potential economic negatives feeding the sell-off that day.
For sure. The sources analyzing this confirmed the unexpected part of that deficit news did have a negative market impact. But they also noted the market drop on the 14th was probably bigger than just the trade deficit miss alone would typically cause.
Suggesting it wasn't the only thing driving the drop that day, even though it contributed.
Right. Other factors were clearly also in play.
You mentioned interest rates possibly needing to rise. Were rates actually going up independently?
Well, rates did tick up a bit on the 14th and 15th, likely linked to those trade deficit fears and the dollar concerns. But interestingly, the sources also mentioned that top officials, like Treasury Secretary Baker and Fed Vice Chair Johnson, were out there around the 15th trying to calm the markets.
How so?
They were basically saying, hey, inflation fears are overblown. The fundamentals don't justify this panic, which suggests that maybe runaway interest rate fears weren't the absolute primary driver of those huge drops on the 14th and 16th, even if rates were a background concern.
Okay, so we have policy worries, economic data worries. But some sources really emphasize the structure of the market itself, things like program trading, portfolio insurance. How do they fit in?
Ah, yes, portfolio insurance.
Yeah.
This comes up constantly in discussions about 87. It wasn't necessarily a trigger in the same way as the tax bill news, but it's often seen as a major amplifier, something that made the crash much worse, much faster once it started.
Right. What exactly was portfolio insurance? How did it work?
It was a hedging strategy used mainly by large institutional investors. The goal was to protect the value of their big stock portfolios against market downturns. They used derivatives, primarily stock index futures, sometimes options, to create this hedge.
Okay, hedging with futures. How did that work in practice? And what was the danger?
The basic idea was, if your stock portfolio started losing value because the market was falling, your pre-programmed strategy would automatically trigger sell orders for stock index futures contracts.
So you're shorting the future to offset losses in your stocks.
Right. The hope was gains on the short futures positions would cancel out the losses on the stocks. And crucially, these sell orders were often executed automatically by computers, hence program trading.
Okay, automated selling triggered by falling prices. I can see where this might go wrong.
Exactly. The big concern, raised by people like economist Robert Shiller, was the potential for a vicious cycle or a feedback loop. It goes something like this.
Lay it out for us.
Okay. Step 1. Market starts falling, maybe due to the tax bill or trade news. Step 2. Portfolio insurance programs see the drop and automatically trigger huge sell orders in the stock index futures market.
Okay.
Step 3. This massive selling pressure drives futures prices down fast, often creating a discount where futures are cheaper than the actual stocks they represent.
A gap opens up between futures and stock prices.
Right. Step 4. Index arbitrageurs see this gap. They jump in to make a risk-free profit by buying the cheap futures and simultaneously selling the underlying stocks in the cash market.
Selling the actual stock.
Yes, large amounts of actual stocks being sold by the ARBs, Step 5. This adds more selling pressure directly onto the stock market, pushing stock prices down even further.
Uh-oh.
And Step 6, those lower stock prices trigger even more portfolio insurance selling in the futures market. And the whole cycle repeats, faster and faster, a downward spiral.
Wow, that sounds like pouring gasoline on a fire, amplified by computers.
That was precisely the fear, and it became a huge point of debate after the crash. Many sources point to this mechanism as a key reason the selling cascaded so violently on the 16th and especially the 19th.
But was it universally agreed that this was the main culprit for the severity?
Not entirely. It's important to note, as some sources do, that there wasn't complete consensus. For example, one source mentions a study by the CFTC, the futures regulator, which argued the negative impact might have been overstated.
They thought portfolio insurance wasn't as damaging as claimed.
Their analysis suggested that while these strategies were certainly active, they might not have been the sole or even primary driver of the collapse to the extent sometimes portrayed. So, definitely a suspect, maybe a major accomplice, but the exact magnitude of its role is still debated.
It just shows how complex these events are, multiple things happening at once.
Absolutely. And related to the computer aspects, some accounts also mention the sheer newness of it all. Wall Street was rapidly adopting computerized trading, algorithms, but maybe hadn't fully worked out the kinks or understood the systemic risks.
Like difficulty handling massive volume, maybe.
Potentially, yeah. Problems efficiently executing huge orders, liquidating assets smoothly under extreme stress. That kind of friction could have made a bad situation worse on a day like Black Monday.
Okay, so we've got this potent mix. A specific policy threat with the tax bill worrying economic data, and then these structural dynamics portfolio insurance potentially creating feedback loops, amplified by new computer systems, all leading to those big drops on the 14th and 16th.
It just sets a very precarious stage.
And then comes Monday, October 19th, Black Monday itself.
The day the bottom fell out, that 22.7% drop. The sources just universally describe it as sheer unadulterated panic, not strategic selling, just get me out.
I can only imagine the chaos on the trading floors. Did the sources capture that human side? What was it like to actually be there?
Oh, yes. Some of the sources, especially the ones collecting personal stories, are incredibly vivid. Brokers, traders, bankers.
Yeah.
They describe scenes of just absolute mayhem and despair. Yeah. Packed floors, deafening noise, just palpable fear, people watching fortunes, client money, their own firm's capital just evaporate in hours. One story from a Reddit thread compiling memories told of a guy whose father was a broker. He came home that night just completely drained, terrified, voice totally gone from shouting orders all day in the pit.
God, that makes it so real. These weren't just numbers on a screen.
Not even close. The human toll for people in the industry was immense. And tragically, yes, there were mentions in these accounts of suicides directly linked to the crash. People who felt their world had ended.
That's horrifying. And the fear wasn't just confined to Wall Street, right? Did it spread?
Even if you weren't directly in finance, the sheer scale of it was terrifying. Another story was from someone who was just a kid then, recalled seeing their dad, also a broker, just sort of incapacitated with anger and hopelessness before a Little League game.
Wow.
For a child, seeing this thing, the stock market, have such a visible, devastating impact on your parent, your family's mood and security.
Yeah.
It really drove home that this wasn't just a headline. It hit home.
So you have that raw human panic. But was there any other view, any counter perspective on what was driving the crash on the day?
Yes, interestingly, there was a perspective shared in the sources from a former sales trader who was right in the thick of it. They described the crash fundamentally as a technical move.
Technical move, what does that mean?
Their argument was that it was largely Wall Street's own doing, getting too cocky and overconfident, as they put it, with all these new derivatives, new algorithms, the early computerized trading, playing with fire they didn't fully understand.
So less about fundamental economic news that day.
Exactly. This view emphasizes the lack of terrible news on that specific Monday. No sudden recession announcement, no war breaking out, no huge company going bankrupt that morning. It was, in this trader's view, an event caused by Wall Street itself. A system breaking under the weight of its own complexity and untested innovations.
That's a fascinating contrast. Pure human fear versus a kind of self-inflicted technical breakdown.
It really highlights that it wasn't just one thing. It was this messy collision of economic pressures, policy triggers, market structure, technology, and ultimately just overwhelming crowd psychology turning into panic.
Okay, so the market collapses. Panic is rampant, maybe human, maybe algorithmic, maybe both. What happens immediately after, Tuesday morning? How does the system even function?
Well, it almost didn't. The immediate aftermath revealed a huge critical flaw in the system's plumbing at the time, the settlement mismatch problem.
Settlement mismatch. Okay, break that down for us. What was it and why was it suddenly such a disaster?
Sure. Back in '87, when you traded stocks, the deal settled on T+3, meaning cash and shares actually changed hands 3 business days after the trade.
Okay, T+3 for stocks.
Right. But derivatives, those futures and options used heavily in portfolio insurance and arbitrage, they sailed much faster. Usually T+1, next day settlement.
I think I see the problem brewing.
You got it. Imagine a big firm on Monday selling huge amounts of stock, maybe because of index arbitrage linked to portfolio insurance selling futures. They also have obligations from their futures trades settling tomorrow, T+1. They need cash now.
But the cash from selling the stock won't arrive for 3 days, T+3.
Bingo. A massive system-wide cash crunch. Brokers and firms desperately needed cash to meet their T+1 derivative obligations, but the money they were owed from stock sales was stuck in the T+3 pipeline. The system was gridlocked.
So the financial plumbing just froze. People couldn't get the cash they needed when they needed it?
Exactly. And this hit crisis point on Tuesday morning, October 20th. Trading basically ground to a halt shortly after the open. The market was seizing up. It looked like the whole system might just break down completely.
That sounds absolutely terrifying. On the brink of total collapse. What stopped it? Who stepped in?
This is where the Federal Reserve, under its brand new chairman, Alan Greenspan, he'd only been on the job a couple of months, played an absolutely pivotal role. The sources are pretty much unanimous on this.
Greenspan's Fed, what did they do specifically?
On Tuesday morning, the 20th, with the market effectively frozen, Greenspan issued this very brief but incredibly powerful statement. It basically said, and I'm quoting the essence here, "The Federal Reserve affirmed today its readiness to serve as a source of liquidity to support the economic and financial system."
Just a statement. Or was there more to it?
Oh, much more. It wasn't just words. The Fed backed it up. They leaned hard on commercial banks, strongly encouraging them to keep lending money, especially to the securities firms that were getting squeezed by that settlement mismatch.
Even if lending to shaky Wall Street firms at that moment didn't seem like a great idea for the banks themselves.
Exactly. As Ben Bernanke later analyzed, it probably wasn't a profitable move for banks in the short term, given the risk. It required the Fed's explicit backing and encouragement. But as Bernanke said, it was crucial for the preservation of the system as a whole. The Fed was essentially saying, keep the credit lines open to Wall Street. We've got your back. Don't let the system freeze.
So they flooded the system with liquidity, using the banks as conduits. Did it work?
It did. The data cited in the sources is striking. During that critical week, the top 10 New York banks apparently almost doubled their lending to securities firms. This massive liquidity injection was the lifeline.
How did it help specifically?
It provided the immediate cash needed to bridge that T+3, T+1 gap. Firms could meet their derivative obligations. With liquidity restored, the immediate pressure eased, and stock trading could actually resume. It thawed the market and prevented a cascade of defaults among brokerage houses.
And the sources often compare this response to, say, 1929.
They do. It's often seen as a key lesson learned from the Great Depression. In '87, the Fed recognized the immediate threat was a liquidity crisis freezing the system's plumbing. They acted decisively as the lender of last resort, unlike the criticisms often leveled at the Fed's response in the early '30s. This intervention arguably stopped the market crash from turning into a full-blown banking crisis and a deeper economic downturn.
So the Fed's quick action was probably the single most important thing that prevented Black Monday from becoming something far, far worse, economically speaking.
That really seems to be the consensus view from the materials we reviewed. It contained the damage primarily to the market itself.
Okay, so the immediate crisis is averted thanks to the Fed. What about the longer term? What were the consequences, the lasting changes, the big lessons from Black Monday?
One of the most surprising things, looking back through these sources, is how quickly the market actually recovered from that incredibly deep low point.
Quickly. Really, after losing almost a quarter of its value in a day.
It sounds counterintuitive, I know, but the numbers are pretty clear. In just the 2 trading days right after Black Monday, the Dow apparently gained back 288 points.
Which was how much of the loss?
That was about 57% of the points lost on Black Monday itself, recouped in 2 days.
57% back in 2 days. That's astonishing.
It is. And zooming out a bit more, the sources point out that the overall U.S. stock market got back above its pre-crash highs in less than 2 years.
Back to the peak in under 2 years. Again, that puts it in a very different category than the recovery after 1929, which took ages.
A completely different recovery profile, and maybe the most surprising statistic of all from the sources. Despite Black Monday happening in October, the U.S. stock market actually finished the full calendar year, 1987, up 2.2%.
Wait, it finished the year positive, even with that crash.
Positive 2.2%. It really underscores how much the market had risen earlier in the year, and how sharp, but relatively contained in time, the crash and immediate recovery were in the grand scheme of that 1 year.
Well, that definitely changes the narrative for anyone thinking it marked the start of a long bear market.
Right. And the sources use this rapid recovery, the positive annual return, to really contrast 1987 with 1929. The 87 crash, while terrifying, didn't trigger a prolonged economic depression like 29 did.
Okay, so the market bounced back surprisingly fast. Did the event lead to any concrete changes, like rules to stop it happening again?
Yes, absolutely. This is probably the most significant and enduring policy change that came directly out of 1987. The introduction of market-wide circuit breakers.
Circuit breakers, like in your house electrical panel.
Exactly the same idea. If there's a sudden, dangerous surge in this case, a massive price drop, the circuit breaker trips and temporarily shuts things down.
How do they work in the market?
They're automatic halts to trading across the entire market. They get triggered if a major index, like the S&P 500, falls by certain preset percentages in a single day.
And these were put in place right after 87.
Pretty much.
Yeah.
The NYSE and other U.S. exchanges adopted them starting in 1988. It was a direct recommendation from the Brady Commission, the presidential task force, set up to figure out what happened in 87 and how to prevent a repeat.
Are they just one switch? Like market drops X%, everything stops?
No, they're tiered. The rules have evolved,
Yeah.
but generally there are different levels, say a 7% drop, a 13% drop, a 20% drop. Each triggers a halt of a different duration.
And the length of the halt depends on the drop size.
Yes, and also the time of day it happens. A halt triggered late in the afternoon might be shorter, or a big enough drop late in the day might just close the market entirely. There are also variations, sometimes called limit up, limit down, bands, or speed bumps for individual stocks or futures, designed to pause trading briefly if things move too fast.
Okay, so it's a structured way to hit pause during a nosedive. What's the argument for having these? Why did policymakers think they were a good idea?
The main arguments are that they curb panic selling, give everyone a forced time out to breathe, assess information, maybe correct technical glitches. The idea is to interrupt that potential downward spiral we talked about with portfolio insurance.
Let cooler heads prevail, basically.
Right. Reduce volatility, prevent catastrophic cascades, allow buyers and sellers to maybe find some equilibrium before trading restarts, protect investors from wild swings.
Seems logical, but I assume there are arguments against them too.
Oh, definitely. There's a strong counter-argument, also detailed in the sources. Critics say circuit breakers fundamentally interfere with free markets. They stop people from trading when they want or need to.
You mean they trap investors? If you want to sell, you just can't.
Exactly. Imagine needing to sell to meet a margin call or some other obligation, and suddenly the market is halted. Critics argue that's unfair and potentially dangerous, depriving the market of liquidity precisely when it might be needed most.
Could it create its own problems then?
That's the fear. Arguments against also include disrupting price discovery, the market's job of finding the right price. And there's the magnet effect theory. If traders know a halt is coming at, say, -7%, they might rush to sell before that level is hit, actually accelerating the decline towards the trigger.
Oof. So it could potentially make things worse right before the halt. Is there any agreement on whether they actually work? Do they help or hurt overall?
This is key. The sources are very clear. There is no consensus on their effectiveness. It's still hotly debated.
Really? After all this time?
Yeah. Their impact might depend heavily on the market structure, who the participants are, whether there are other places people can trade, like overseas markets or different derivatives, when the main market is halted. And it's hard to prove statistically.
Why is that?
Because market-wide halts triggered by massive drops are, thankfully, very rare. One source mentioned that between '88 and the early 2000s, a full market-wide hold was only triggered once in the U.S., back in October 1997. Hard to draw firm conclusions from such rare events.
Right. Not much data to work with.
Exactly. And the sources note different approaches globally. While the U.S. went with circuit breakers, Hong Kong, for instance, explicitly decided not to after '87. They preferred letting market forces work, only reserving the right to intervene in truly disorderly conditions, aiming to keep markets open. So a real philosophical split.
Fascinating. Different answers to the same problem. Were there any other lasting impacts from '87? Maybe less obvious ones?
Yes, one quite significant impact was on how financial professionals think about and price risk, especially in the options market.
Options pricing. How did a crash affect that?
Well, before 1987, the standard models, like the famous Black-Scholes model, basically assumed that gigantic sudden market moves like a 22.7% drop were incredibly rare, statistically almost impossible, like a 6 or 7 sigma event. Black Monday showed that assumption was dangerously wrong.
So the real world proved the models were too simplistic.
In a very dramatic way.
Yeah.
The crash forced quants and traders to realize that these extreme tail events, these massive crashes, were much more likely than the standard math suggested.
And how did that change things?
After '87, you saw the volatility smile, or more accurately for stocks, a volatility smirk become much more pronounced. This means that options that protect against big downside moves out of the money puts started trading at much higher implied volatilities compared to options closer to the current price or those protecting against upside moves.
So the market started pricing in a higher chance of another crash.
Essentially, yes. It baked the possibility of another 1987-style event into option prices. It showed the limitations of models assuming nice, neat bell curve distributions and spurred the development of models that better account for these fat tails, the higher probability of extreme outcomes.
That's a really interesting technical consequence. Okay, so bringing it all together, the crash, the panic, the surprisingly fast recovery, the Fed's role, circuit breakers, even option pricing changes. Why does it feel like 1987 doesn't loom as large in the public imagination as, say, 1929 or even 2008?
That's a great question, and the sources offer several interconnected reasons, especially drawing from those retrospective accounts and economic analyses.
What's the biggest reason?
Probably the most important one is that, unlike '29 or '08, the 1987 crash didn't really spill over catastrophically into the real economy for most people.
Meaning no deep recession followed.
Exactly. There wasn't a major prolonged recession tied directly to the crash. No widespread surge in unemployment across the country, no housing crisis. Life, for most people outside of Wall Street, didn't fundamentally change in the way it did during the Great Depression or after the 2008 financial crisis.
That makes a huge difference in collective memory, I imagine. If your job wasn't lost, your house wasn't foreclosed on.
It feels much more distant. And tied to that is the Fed's effective response we discussed. By preventing a banking crisis, they stopped the contagion. '29 and '08 both involved severe banking problems that amplified the economic damage. '87 largely didn't.
And the quick market recovery itself probably played a role.
Definitely. Back to pre-crash highs in under 2 years, finished the year positive. For long-term investors who didn't panic sell, it ended up being a scary blip, not a decade-long disaster like after '29.
And there's also the point about who actually owns most of the stocks.
Right. While many Americans have some stock exposure, maybe in retirement accounts, the sources point out that the vast majority of stock value is held by the wealthiest households. So, for the average person, the lack of widespread job losses was likely far more impactful and memorable, or unmemorable in the case of '87, than the temporary dip in their 401k.
So, bottom line, a brutal market event, terrifying for participants, but its broader economic impact was contained, thanks largely to the Fed, and the market recovered relatively fast.
That seems to be the general conclusion from the sources. A sharp shock, but not one that fundamentally altered the economic landscape for most people in the way other major crises did, hence less historical weight in popular memory.
Which brings us finally to the lessons. What should investors today take away from the whole saga of Black Monday?
Several timeless ones emerge from the sources. First, and maybe most obviously, markets are volatile, sometimes violently so. Crashes can and do happen. Understanding that risk and managing it appropriately for your own situation is just fundamental.
Rule number 1, expect the unexpected sometimes.
Pretty much. And closely related is the danger of panic selling. Those stories from '87 show how intense the fear gets. But the data, including that quick '87 recovery, shows that selling everything at the bottom is often the worst thing you can do.
Locking in losses.
Exactly. Diversified portfolios, held for the long haul, have historically recovered. Which leads to the next lesson.
Long-term perspective.
Crucial. And structuring your finances so you aren't forced to sell during a downturn. If your investment portfolio is for goals years or decades away, and you have cash for near-term needs, you can afford to ride out the storm without selling into the panic.
Don't invest money you might need tomorrow.
Basically, yes. And one final point. While we talk about the quick recovery and contained economic impact, it's vital to remember those human stories. For the people caught in the middle, the brokers, the traders, the families affected, the day itself and the aftermath were incredibly real and painful.
Right. It wasn't just an academic case study for them.
Not at all. Understanding the systemic stuff is important for policy, but remembering the human cost is important too. It reminds us what's actually at stake.
That's a really important grounding point. Okay, so to quickly recap our deep dive, Black Monday 1987 was this unprecedented crash, likely triggered by a confluence of factors, specific policy news, like the tax bill, possibly amplified by market mechanics like portfolio insurance and early computer trading, leading to sheer panic.
Followed by a critical liquidity crisis averted by decisive Fed action.
Resulting in surprisingly quick market recovery, lasting changes like circuit breakers, but ultimately an event that faded somewhat from public memory due to its limited impact on the broader economy compared to other crises.
That sums up the key threads from the sources pretty well.
It really drives home how economics, policy, technology, and just raw human emotion can interact in really dramatic ways.
Absolutely.
And that leaves us with a final thought for you, the listener. It's been decades since Black Monday. Technology is faster, markets are globalized, we have circuit breakers. But can panic still happen? Can markets still make huge, rapid moves? Almost certainly.
So, what does the story of 1987 teach us today? Perhaps it's about the enduring power of market psychology, the limits of our ability to predict short-term chaos, and why having robust financial systems and cultivating sensible long-term investment habits remains so critical.
It really shows that even if the market eventually recovers, understanding why these extreme events happen and how the system responds is vital knowledge for navigating finance then and now.
Well said. A history lesson with very current relevance.
Thank you for joining us for this deep dive into the crash of 1987.